There we go. My mic was muted. I knew something was wrong this morning. Welcome, everybody. 8:30 Mountain Time. Oh, I'm a minute late by the time I got my mic unmuted. Thank you, everybody who is joining me. Welcome to Mornings with Scott Live. Elon Musk never ceases to entertain. Let's get rid of this music here. I woke up late and I'm all frazzled this morning. But we are organized and we're on it. So Elon Musk never ceases to entertain. Do you follow him on X or any of his other postings? You know, when Trump was, when there was the assassination, when was that? Over the weekend, I think, whatever day that was, the assassination attempt where the firefighter tragically was killed. One of Elon Musk's response on X is he posted that he unequivocally supports Trump. He's not nominating him, but supporting him to be president of the United States, which was a big deal for Musk. I think those of us that may follow his career and his musings would know that he's recently leaned right, but he's never in his life voted for a Republican or supported a Republican. He's been 100% Democrat all the time, but he's very anti-Biden. And so he posted that he completely supports Trump. That was his reaction to the assassination attempt. And 2 days later, he announced that he was donating, which he has never done to a Republican, donating to a super PAC. And how much? You know, he's one of the richest guys in the world, so you think maybe it's a lot of money. Well, it's more than a lot of money. He's donating, he says, $45 million, not once, per month. $45 million per month until the election, which is what? $180 million, $200 million, depending on how you're doing that math. I mean, it is a crazy amount of money that he is donating to a Trump super PAC. And then last night in my sleep, I was thinking to myself, I wonder if that $45 million a month is exclusively tied to advertisements on X. Because if it was tied to advertisements on X, what a wonderful tax play that would be. You donate $45 million a month to a super PAC personally. Those of you in the US that are on the listeners, please correct me if I'm wrong, but I'm pretty sure there's a healthy tax deduction associated with that. It goes into the hands of the super PAC. They promote Trump on X, of which you get 100% of the revenue, right? Because you own X and it's a private company. So that all really goes back to you, where you have lots of tax losses. And so you have the tax deduction over here, you funnel the money back through X and you use up your tax losses. And what a great shelter that would be. I'm not saying he's doing that. I'm not creating a conspiracy theory out of this $45 million per month donation. But wouldn't that be a interesting way to use up some tax losses and create a personal tax gain? Who knows? And support a candidate all at the same time. I guess the world is open to you when you have that much money and a social media platform to play with. So yesterday, Musk, it was reported in the Wall Street Journal, announced that he is moving X and SpaceX headquarters from California to Texas, X being the former Twitter. For those of you that don't follow social media platforms, if you've been living in a hole or a cave of some sort for a little while. And so, so he's moving from California to Texas. And again, this was just yesterday's news. So a few days after he announced that he was supporting Donald Trump and doing this donation. And as the Wall Street Journal reports, his disclosures followed the move by California Governor Gavin Newsom, a Democrat, to sign a new law past Monday, that aims to prevent schools from informing families if their children identify as gay or gender. So if a child comes out at school, identifies as gay or identifies as transgender, the school's not allowed to tell the family. That would be against the law to tell the school's parents. Better that the government knows and that the family can't know, according to California Democrats. To which Musk replied, "This is the final straw." And he did that on X. He posted that. He cited the law as well as, quote, many others that preceded it, attacking both families and companies, end quote. He said, I did make it clear. So, I mean, Musk has had a lot of problems with laws in California, but also regulations that just make it impossible to manufacture and do business in California. No sane business person would open up a business in California in the current political climate. He said, I did make it clear to Governor Newsom about a year ago that laws of this nature would force families and companies to leave California to protect their children. So that's what happened. So what did Newsom say about that? It's a pretty big deal. You're losing X, you're losing SpaceX headquarters in that tax base and employee base and population base. And this is just one of a steady stream of businesses that have been exiting California under Newsom's governorship. Well, Newsom replied to this on X, but before I tell you what his reply was, which was pretty good, by the way, you need a little backstory. The backstory is that way back in the Trump presidency, let's say 2017, Trump tweeted that Musk had come to the Oval Office, and this is when Trump and Musk were not getting along at all. He came to the Oval Office and he was asking for subsidies, as Trump said, for cars that crash and rocket ships to nowhere, and many other projects, and that if he didn't have subsidies, he would be worthless, Trump said. And Trump said in this tweet that I could have said to him, get on your knees and beg, and he would have done it. So that was a nasty little exchange between Trump and Musk back in the day in 2017. And so this morning, literally this morning, Gavin Newsom, replying to the Wall Street Journal article and the Elon Musk post that he was leaving California for Texas, Newsom posted a screenshot of that Trump tweet, and he said, quote, you bent the knee. That's a pretty good reply. You bent the knee. To which Musk replied a couple hours later, quote, you never get off your knees, end quote. Now, you may be asking yourself, Scott, did you just tell me that whole 8-minute story to get to the punchline of you never get off your knees? Yes, that's exactly what I did. There was really no other point to that story than for us to laugh, for me in particular, to laugh at the way billionaires and political elites behave with each other. You never get off your knees. Well, yesterday we talked about a global recession. I pointed out that luxury goods are in decline. We learned that there were, in fact, brands that we'd totally forgotten about, like Burberry and Swatch. Who the hell knew those still existed? And that global sales are declining. It's blamed mostly on the China economic decline. And so the Chinese have been really part of the explosion, or the cause of the explosion of luxury good sales over the last however many years. And so that's going through a rough patch. So, and we learned from JP Morgan yesterday that luxury good sales are a lagging indicator of economic activity. In other words, it's sort of the end of this. When you see luxury goods decline, that's kind of the end of the cycle and you're getting close to the bottom, but we are in an economic, it is an indicator that we're in an economic bust right now globally, not just in the US or in Canada. And I showed you some stats yesterday, or told you some stats that insolvencies, bankruptcy filings of businesses are way up. They're way up in Canada. They're way up in the US. I don't remember the numbers off the top of my head, but it was like 20%, 50%, whatever. They were way up year over year. So we have lots of indications that economically things are not very good. So what does this mean for business and households? Well, what it means is we have slowing economic times, which means we're have a slowing labor market. We have continued interest rates, continued inflation, which is crushing everybody, right? In businesses, the cost of borrowing is high. As loans come up for renewal, it's going to be a real problem. Your debt service is going to be triple what it was if you took that loan 5 years ago. The inflation number is still high. They're reporting 3.8% in various places. So it's still a high number of inflation, and people, I think, that are not economic, not financial, that are just normal business owners, they listen to the politicians like Biden, who says, prices are coming down, inflation is coming down, and so the cost of goods are coming down, which is not what happens at all. If inflation is coming down, it just means that the price of goods is growing at a slower pace than it used to grow, right? So if you have 2% inflation, it means the price is going up 2%. If you have 10% inflation, it means the price is going up 10%. Either way, it's going up. There's no scenario where those prices are coming down unless you have, negative inflation, deflation. So that's and you don't want that. That's also a really bad scenario. And so prices are not coming down. And because of that, we're still suffering in the business world, but also in the consumer world, right? Your mortgage rates are going up. You have to go to renew your mortgage. It's the exact same thing. You go to renew your mortgage, your debt service is way up. The cost of food is up astronomically. And the things that energy, the things that you need to buy are way more expensive. And yeah, maybe you got a raise because labor has gone up as well, but the raise didn't cover the increased costs, right? So you're negative. You're negative right now since the Biden administration. Wall Street Journal reported a few days ago that the merger and acquisition world, the business world, buying and selling of businesses, is up significantly. The activity is up largely because interest rates are stable. This is an important concept. They're not down. Interest rates are still high, but they're stable. And what we learned from that is even though inflation is still up, interest rates are still up, the economy and business people and you and your business need to find a way to adjust. You need to find a way to adjust to the current environment. And as long as it's stable, you can do that. It's when you don't know if you're going to have skyrocketing interest rates or skyrocketing inflation rates. You don't know. Therefore, you can't make decisions. It's the uncertainty that makes business really, really difficult. Organic Chef Heather. Hello, Organic Chef Heather. It's hard for me to see comments on the Instagram platform because it sucks in coordination with the StreamYard platform, but thank you for joining there. And so when the shock of the change, interest rates, inflation, tightening monetary policy, meaning no credit for businesses, right? Remember, we had bank failures and you can't go out and find any money to run a normal small business. When that all happens, there's disruption and there's uncertainty, but when it stables out, when it becomes the norm, then as a business owner, you can start figuring out what to do about that. And as the Wall Street Journal reports in the last few days, M&A is up largely because interest rates have been stable. Interest rates in the US, I think current prime right now is around 8.5%. I don't want to be held to this exactly because I got this from ChatGPT and it lies to you all the time. But current prime rate is around 8.5%. And it's been unchanged for about a year. In Canada, we're 6.95%, I believe. And there have been some recent changes, but not very much. And so during President Biden's administration, the inflation. So we're going to talk about inflation as it relates to interest rates, because these are really, from a business owner's perspective, one and the same thing. Okay. When inflation goes up, interest rate goes up, and vice versa. It's really that simple. You don't need to be an economist. You don't need to be a finance person. It's really this simple. So under Biden's, and I'm going to explain that to you because I think it's important to know that, at least from my understanding of how this all works, because nobody really knows how inflation works. Let's face it, even the economists really have no idea. But I think it's important to have a theory about this that predicts well when you are a business owner. So during the Biden administration, we have a, bear with me. There we go. I must have said the word SIRI because she's trying to interrupt me as I'm doing my live stream here. So during his administration, the average inflation rate has been 5.7%, which of course under Trump, it was 1.9%. Under Obama, even better, 1.4%. Under Bush, 2.8%. So that's sort of the norm of what you would think it should be. And under Biden has been much more than that, 5.7% for Biden as the high average, and Obama had the low average. Peak inflation, 9.1% in June 2022, which was under Biden, which was a 40-year high. By the way, did you notice during the disastrous debate between Trump and Biden, there was so much news coming out of the debate about the cognitive state of Joe Biden, which I think was overblown, by the way. My hot take on that back when is he did way better than I thought he was going to do. Didn't say he did good. He did terrible, but I thought it was going to be worse. The bar's pretty low for him. And anyways, he did say during the debate, and I think it was missed, he said, hey, man, the economists told me if I did these things, our debt and inflation would skyrocket. And that's what would happen if I implemented my policies. Well, look at me now. Look at me now. We've almost got inflation under control. So the sentence made no sense, but he actually admitted that he was advised if he changed the policies to what he changed them to, that debt was going to skyrocket and balloon, and that inflation was going to skyrocket as well, which of course is exactly what happened. Why did that happen? For me, here's the point. If you're a business owner, I think you need to understand how the political environment impacts inflation, and at least try to be predictive about it. And here's a model that's worked really well for me. I don't think about, oh, inflation is the lessening or the loss of value of money, although that's probably true. I'm just not smart enough, and I'm not an economist to try and do anything. Like, what does that mean? I know what it means, but how does that help me? Instead, I think about strictly supply and demand on a good, on a pair of glasses, on an iPhone, on all of the inputs that go into manufacturing these things. And here's the bottom line. If there's more demand, prices go up. If there's more supply than demand, prices go down. It's really that simple, right? So increased monetary supply, meaning increased credit available to consumers, available to business owners, means that demand goes up and prices go up, right? If you decrease the credit available to businesses, if you limit the credit available to consumers, demand goes down, prices go down, therefore inflations go down. Why do we have tightening credit over the last year or two, and bank failures, and all of these sorts of things that impact your ability to go and raise money? Well, because we need to clamp down on demand so that inflation comes down from its peak. And therefore, one way to do that is to make sure there's less money in the system or less credit available to you, right? Entirely predictable. So you should have, with this model of thinking, you should have been able to think, 3 years ago, oh my goodness, inflation is really high. Not only is that causing my micro problem today, but a year from now, there will also be no financing available to me. You should have known that. I knew that because of this model of thinking, because one of the ways to fight the inflation is to lessen demand. How do you lessen demand? Less credit available to consumers and to businesses. Also, you can increase interest rates. If you increase interest rates, your cost of borrowing has gone up, and therefore you have reduced demand, and therefore you are fighting inflation. You lower interest rates, you can increase demand, and that will increase inflation as you do that. So you should have been able to predict when you saw high inflation at the beginning of the Biden administration, you should have been able to predict, wow, interest rates are going to go up and there's going to be less money available to me. So I've got a real problem. I need to figure out a business plan that works in that environment, right? On the supply side, which is what I think drove this inflation, drove this inflation. If you have restrictive energy policies, remember, energy goes into everything. There's almost nothing that you buy apart from financial services and education. Really, those are two large sectors of the economy that are not very tied to energy. But apart from that, almost everything you buy in your day-to-day life has an energy cost in it, an energy cost in terms of its manufacturing input or transportation or whatever. Okay, so energy is a big deal, and if you restrict through regulation energy energy, then you're limiting the supply of energy. Therefore, prices are going to go up and inflation is going to go up. So when you see at the beginning of the Biden administration, canceled pipelines, a war on fossil fuels, I'm not commenting as to whether you think that's a good thing or a bad thing. It doesn't matter. But what does matter, if you're a business owner, that's very obvious, is that if you do those things as a government, you're going to create inflation, supply and demand, increased regulation across the board. What was one of the primary differences between Biden and Trump? Regulation. Biden is extraordinarily heavy on regulation, and Trump was wiping out regulations faster than any president in the history of the United States, right? Regulation is a restriction on the ability of a business to produce goods. It limits supply. I'm not saying that's a bad idea. Maybe some of those regulations are really, really important. I have no idea. You have to go one by one to try to figure that out. But the fact is, if you have a bunch of regulation, you're going to limit supply, and limiting supply drives up prices. We should have been able to, inflation. We should have been able to predict that. And so as a business owner, it's really important, I think. Remember the story I said yesterday about the 6-foot guy drowning in the 5-foot average river, right? I love that story. The 6-foot guy drowns in the 5-foot average river. You have to survive the dips. And when you see an administration in the US or in Canada, same thing, by the way, when you see an administration come in and they're heavy on regulation and restricting energy, you know that that's going to create inflation, that prices are going to go up as a result because of the supply demand. And you know that when inflation goes up, interest rates are going to go up, your ability to borrow is going to go down. It was entirely predictable. I've said it before in this show, and here we are again as a reminder. So, and then, the worst part is with inflation is once it starts to get out of control, you just don't know what's going to happen. Because, okay, as a business, and this happened to me and to every other business probably on the face of the earth, you're running a business and all your input costs go up. I am running a business. I'm not going to tell you which one. Actually, I was running a couple of businesses, and the input costs of the commodity used in those business, think steel, think rubber. Well, some of them tripled during the pandemic. So our input costs go up 3 times, right? And then households are experiencing inflation under the Biden administration. So what are they doing? Well, they're coming back and they're saying, hey, we need raises. We can't afford to eat and pay our rent, which is perfectly fair. And you see that in all the labor disputes going on across the board in both countries, because everybody needs more money just to be back to equal. And so the system is trying to fight that out. So as a business owner, your input costs are up. You got a lot of pressure to put through raises. So all your costs have gone up dramatically. Therefore, you need to pass through as much as you can to your customer. Hey, I need price increases. And then, of course, your customers are fighting back on that because all their costs are going up too. And the last thing they want is from you, your costs the cost of your product going up as well. And so everything's just going up and up and up. And it turns into this vicious cycle, because when you pass through the price increases to your customer, now they're passing it through. If you're in midstream, if you're manufacturing for somebody or wholesaling, they're passing on to the consumer. At the end of the day, the consumer just has more prices going up, and now they need more raises, and it just becomes this vicious cycle, right? Well, how vicious in Venezuela, just for an example, in 2018, you had hyperinflation reaching over 130,000%. 130,000% in 2018 was the inflation. Everything just cratered. That's how bad the inflation could be which is why it has to be a priority of governments to manage the inflationary spiral. And they do that entirely predictably by killing the economy. Interest rates, reducing capital, that impact your business, and you need to know that. So what else do I have here? I need to cut this short. That's it. Let's just move on. Unless anybody wants to talk any more about interest and inflation, I'm done with this for today. Let's move on to our segment, Financial Literacy for Business. Financial literacy for business. When I go around speaking, which I do, people come up to me. The most common thing they say is, "Wow, that was a fantastic speech. That was the best speech I ever heard. I've learned so much. I love the stories, the war stories that you tell. I'm going to implement. I'm motivated to implement some of this into my business. But I got to tell you, there's a lot of your speech I don't even understand. I don't know what these words are that you're saying. I don't understand their terms. Is there anywhere that I can go to understand the literacy of finance and business and what you're talking about so I can be better educated and raise more capital and earn more money," which is the point of the scottsinclair.com. Well, the balance sheet. Well, for that, I've created a financial literacy for business series, and you can see that on all my channels. And today we're going to talk about the balance sheet. What is the balance sheet? Last week we talked about return on investment. This time it's the balance sheet. What is the balance sheet, and why do we care? The balance sheet is a snapshot of your business's financial position at a specific point in time. When you get your financial statements from your accountants, you're basically getting three statements. You're getting a balance sheet, you're getting an income statement, you're getting a cash flow statement, and you're getting the notes to the financial statements, okay, which is some description as to what all these things are, the line items within those statements. The balance sheet itself provides a summary of what your business owns, which is assets, what it owes, which are its liabilities, and the equity, what is left over, which is for the benefit of the owners of the company, okay? So you've got assets, liabilities, and equity. And the balance sheet, every balance sheet is divided into those three main sections. On the left-hand side, you have your assets. On the right-hand side, you have your liabilities at the top and your equity at the bottom. It's those three things. So assets are resources that are owned by the business that provide a future economic benefit, right? So that could include cash, inventory, prepaid expenses. That has a future economic business. Could include your fixed assets like manufacturing equipment or real estate. Okay, so all of those things are things that your business own and that go on the asset side of the balance sheet. And they could be broken into current, which would mean things that you're going to probably realize the benefit from in a year or less, like cash or inventory, and long term, which would be things that stretch out, the benefit of that stretch out over a long period of time. And for that, you could think, say, real estate or manufacturing equipment. There's something that has a useful life for much, much longer. The liability side is not things that you own, but rather obligations of the business, things that you must pay in the future. And like the assets, they are also divided into current and long-term. Current means basically you need to pay them in a year or less, and long-term would be you pay them longer. Think accounts payable. You have a supplier payment. You need to pay that. You have credit, 30 days, 60 days, whatever. So that's less than a year, and you need to pay that. And then you have a manufacturing term loan, right? So you bought a $100,000 piece of equipment, you're paying it out over 7 years or whatever. Well, that's longer than a year. That is a long-term obligation. Assets, things you own. Liabilities are your obligations. Equity is the difference between the two. It represents the owner's claim on the business after the liabilities have been paid. And the line items of equity would be things like common stock, retained earnings, and different categories like that. There's more, but we don't need to get into too many of those details. And so the fundamental accounting equation is assets equal liabilities plus equity. So you have assets on one side You have liabilities and equities, and when you add them up, it's the same number as the asset side, which is why it's called a balance sheet. It has to balance. I would suggest to you that the actual accounting equation is that assets minus liabilities equals equity. But in terms of presentation, think of it the same equation, just expressed differently. Assets equals liabilities plus equity. Okay. Obviously, you need to understand your balance sheet. When I am analyzing a business, when many financial analysts are analyzing a business, we go first to the balance sheet. I think if you're not a financial analyst, can't talk this morning because I woke up late and I'm not done my coffee. When you're uninitiated, you probably run straight to the income statement and ignore the balance sheet. The income statement is how the company performed, and we'll cover this probably in the next Literacy for Business series episode, probably next week. But the income statement is how a business performed during a certain period of time. And the balance sheet is a statement of what you own, what you owe, and the equity that is left over. Do you know what the difference between a balance sheet in period 1 and a balance sheet in period 2 is? It's mostly the income statement. The income statement explains how things changed. So if you're an analyst or a banker, you're going to spend a lot of time on the balance sheet. You're going to look at ratios that come out of the balance sheet that we'll talk about, like working capital ratios. You're going to look at debt to equity ratios. You're going to look at the type of debt that you have and whether you're going to run out of money or be bankrupt soon, right? So understanding your balance sheet and recording things properly that give you the best opportunity for success is really, really important. Let me give you an example. Let's say you have, I'm just going to do this off the cuff. I didn't write this down, but let's say you have assets and liabilities, and your liabilities exceed your assets, which turns out to be negative equity. But a great part of your liabilities is, in fact, money that you lent the business as the business owner. So it's called a shareholder loan. Is that shareholder loan really an obligation? Are you really going to pay yourself back? Or is that equity-like, right? And so we'll talk about that more on future episodes of Financial Literacy for Business. But if you understand your balance sheet and what your stakeholders are looking for, you can start separating out and providing further disclosure to help you, as we say on thescottsinclair.com, raise more money, raise more capital, earn more profit. That's the whole goal of all of this. And you need to understand the terms and what your stakeholders are looking for when they look at various parts of your financial disclosure, in this case, the balance sheet. All right, those are all my prepared remarks for today. I have gone over time. I apologize for that. Nobody has any comments that I am aware of that I need to address. So I think we're good. We'll see you tomorrow, 8:30 Mountain Time, Mondays to Fridays. This is a new live stream. It's been going pretty well, and I do try to keep it from 30 minutes, but I was over today because I was late and disorganized a little bit. Thanks, everyone. Talk to you tomorrow.